Hi everyone, this is Rohit Srivastava returning to you on the 12th of July 2024 with what I think is going to be a very, very important podcast. The reason I say that this is going to be important is because of the type of turning point we are really seeing today. Yes, I am recording this late in the night, and because of the readings that I am seeing, which are starting to set and confirm a point of view that I've been trying to make for several months now, and also something that I've been looking for a final confirmation of. And of course, this has to do with macro. A lot of people know that I connect the dots between macro, what is happening in our own Indian stock market, and that what gives you greater confidence in the overall picture. And that is something that is happening right now. We've been in a bull market, one of the longest in a long time, and much stronger and broad-based bull market than what we saw in terms of the bullish trend between 2010 and 2020, because that period was led by a few sectors. What we are seeing right now is being led by multiple sectors and stocks, and that's very interesting because this is what you call a real bull market. And the greatest concern of this real bull market in India has been, have we gone too far? Can we really invest today if I have more money? Is it overvalued? Is this a bubble? Is the US a bubble? What if the US falls? What will happen to India? These are the common questions I'm facing almost every day as I meet investors and traders. And they're very important questions. They're relevant questions that you should be asking. But the answer is this: bull markets don't just end on a whim. They usually end when there's excess of a different nature. It's not just valuations are one of the symptoms of a bubble, but real bubbles pop when you've blown them too far, and especially when there is too much leverage in the system. So leverage is a very, very important word in that context, because excessive leverage, which comes from borrowing and buying stock, creating too much positions in the futures market, etc., those are the things that are really behind bubbles and their eventual demise, right? So even some of the biggest corrections in the markets which occur from excessive positioning, we used to see these huge moves, 20-30% corrections during a bull market, 2006, 2004, also caused by not just events but positioning. So positioning is always a concern, but before positioning is where you get liquidity. And our current markets, the theme of current markets has been driven a lot by liquidity and global liquidity, to put it very, very centrally. Governments have, of course, played their part in aiding the growth cycle through government spending, but on the other side, the funding of that and the liquidity has to be provided by central banks, and with low interest rates and QE or some form of bond intervention. So many of these things have helped. They've come and gone. COVID provided another reason for everybody to step on the gas, and the subsequent inflation has scared everybody enough to believe that maybe we finally made a turn from the liquidity based bull markets, but it looks like that's not the case. In the case of India, we have many more triggers than we realize on our side. As long as we have a stable global environment and domestic political environment, we can continue to have this investment cycle extend itself on the back of different sectors. Rotation has been something that we have come to deal and live with, but rotation plays a very important role in this whole thing playing out the way I'm saying, that you can have certain sectors, you can have certain stocks that are overvalued, but that doesn't mean that the whole market is overvalued, right? The whole market as a whole doesn't have to fall apart because of a few stocks or sectors. And what would fuel something like that is only the continued provision of liquidity, because if there's a lot of liquidity, if there's a lot of money, it has to go somewhere. And if it doesn't go into the overvalued segments, which can then start underperforming, they will start going into other segments of the market, which will then start outperforming. And that is how the rotation takes place. and allows for a bull market to extend its course longer than you would have thought otherwise. So that's exactly where we are, the state of affairs, that our bull market, while it may look stretched in some fronts, there are many fronts on which it is not. And if you don't fully understand this, the right way to do it is to go and open historical valuation charts on the Strike valuation setups. What is Strike? If you're new to it, Strike is the latest web-based platform for all equity market investors. They can get access to all market data visually thought in the form of charts, which are interactive. And so you can compare history and take decisions based on where the market was in the past on the same data point. The data point could be anything, whether it's the positioning of institutional investors, whether it's the fundamentals of a company, or whether it's the options open interest. Whatever data point you choose, view it historically and take a decision. That is what you should be able to do with Strike. Where do you find it? web.strike.money. Just type that out into your browser and start your 7-day free trial. So that is what you need to do. But coming back to the data, historical valuation charts can show us that some sectors, while are in extreme overvaluation zone, whether it's the defense and railway stocks or other PSUs, there can be many others which have not gotten there, which have consolidated over the last 6 months, 12 months, 2 years, and actually coming out of those consolidations into fresh trends. And so you have stocks that can actually drive another bull cycle. You have sectors that can do that, and they're completely different from the ones that were actually already doing so. And because that rotation is possible, it's possible for these markets to extend longer. You just have to make the right choices. But I said somewhere in between all of this that one factor that is, making it possible is liquidity. Because if liquidity was running out of maybe some of the winning sectors of the current moment, then the losses wouldn't really allow you to buy something else in another stock or sector, and then eventually that would mean overall pressure on everything. But when liquidity is strong, you can have a situation where fresh money moves into other segments while old money moves out of the existing overbought segments, and so you can have rotation. And that liquidity is getting fueled from various fronts, especially globally, not just the government spending in India. And global liquidity just got a big fillip. The data points to actually support widening global liquidity have been there for a while. The reasons in the form of a US election that is coming up, or China that is in a tight spot with its economy, have also been places that are ready to provide liquidity and have been doing so in stages. And if they step on the gas, then we would see a very changed environment. Now, China has been trying to step on the gas, but not aggressively. Japan, which needs to pull back because its currency completely falling apart, needs to probably strengthen or raise rates into the yen. Okay, so that's the only one which is diverging away from the rest. But in other places like India, you have the potential for rate cuts, but it is still a debate. Can we really cut too much, especially when US rates are higher? Can we allow the currency market to be impacted by decisions on the bond market taken by the RBI? So I'm sure RBI will be prudent about that based on the amount of and size of flows that we really get. They can actually move in the direction of lowering rates. But till that point of time, they may try to hang on. But what the markets are signaling in terms of expansion of liquidity, especially globally, is that bond yields have started to slip. Now, every month we've been watching US CPI data, and then the markets start doubting that data. Is it really weakening? But if you look at the last several months of CPI inflation, it has actually been trending down month after month. So the Y-on-Y data I'm talking of, or even if you take core PCP, PC inflation, both of which were reported today, core CPI and CPI, both came in lower than where they were last month. I think the core came in at 3 and the other one came in at 3.4, which was, a basis point below last month, and 4 basis points in terms of the core. And with these data points coming off, what it really means is when it goes from 3.4% to 3, it's a significant decline in the current rate of inflation. And as the current rate of inflation cools, the expectations of the Fed moving towards a final rate cut by September, at least the first in a series, start to grow. And that doubt was coming in between. Will they do it? Won't they do it? Because the data was moving down slowly. Well, it is still moving down slowly, but what is consistent is that it is moving down. Month after month after month, we are seeing the inflation data really head lower. And that makes a huge difference in terms of the call. And what it does is that it sets the stage for what the Fed really wants to do, which is lower interest rates. And so immediately you've seen the bond market rally, bond yields come down. You've seen the dollar sell off very, very sharply, breaking last month's lows. So both the bond and dollar markets really confirming that their next leg down has started. Yields falling, the dollar falling because they broke their previous lows. And they're doing it cleanly, they're doing it rapidly, which means we can have much further declines in these before it's done. And that's something we should watch out for. But basically, the market is front running that. So when you look at US equities, so this is what it is signaling. Why am I so excited about the whole thing? Is because I've been saying that bond yields will come down, the dollar will fall, and that will be a trigger for the Indian markets, for emerging markets, and everything. And we are getting that today, and we are not getting that today, and its signs are visible first in the US itself, because it's immediately led to a sell-off in tech stocks, which were going up so strongly over the last couple of days. And the sell-off in tech stocks on the other side has seen a rally in particular sectors, right? Industrials are up, but the bigger ones, banks, US banks have broken out from a falling channel 2 days ago, and that rally is continuing to sustain. The Russell 2000, the small cap index, one which was most troubled because of high rates and the tight scenario, that, it has actually come down. And we are seeing the impact, of the data on bond yields, right, and on the dollar. So this meaningful impact where it is pushing these to really break down, and for something like the Russell, which was stressed by the whole idea that high yields are impacting their earnings, and many of these stocks are actually net borrowers, and the easing of interest rates releases a pressure pump. So the Russell 2000 essentially went past the last 2 months highs all in one day. That is what it has done. And that's a signal I've been waiting for. Shall it start third wave? So the bank index also did that a while back. Then it made a new high indicating it's starting third wave, but then it pulled back again. And now the Russell is doing that, and you're seeing the mining stocks close to breaking out. Oil and gas index has already broken out. And what does all this mean in a nutshell is that we are ignoring the area that was considered overstretched, overvalued, which is the Nasdaq of tech stocks. And you're getting focus back to the industrials, mining, and commodity related segments, among others. And I do think banking also will do well. And if you put all of that together, you have a recipe for a strong bull market continuing from here, despite the correction that we typically get in pre-expiry week, which is next week. We should see strength in the Indian market. And so that is the net conclusion I am taking away from all of this. And in fact, Bank Nifty also today did not break the 20-day moving average, held on to it even though it was down on the day. I'm sure some people would be upset about the idea that you didn't get a US correction. Then you just have to wait for it. I'm not sure it happens immediately or happens after some kind of a bounce on the dollar, because we will see some retracement, before things continue in the given direction. And so that is the only thing to really wait out for. So we have this setup where, a lot of things are being triggered in terms of what is happening in the liquidity front, and it's causing all the interest rate sensitive sectors to move higher. And I think that will rub off on India as well, which means banks picking up, real estate, metals, everything that's related, directly to consumer to some extent, autos, all get a positive rub off from falling interest rates or bond yields. And so you'll see many of these markets start to gain traction Even though some may have given you signs of feeling tired, the tiredness may only end up being temporary, but the strength will be much more long lasting. And so, in a full circle, when we come back to our own market and we start talking about the Nifty, the possibilities of it going to all-time highs and stretching not just for a week but a month, but months and months ahead are becoming real possibilities with some of these trends getting carved in stone, right? If the US continues to indicate lower rates, you get further confirmation of that. I don't think all of US markets will keep falling. Even the ones that are weakening today will eventually pick up. And that expansion in liquidity, this one's from the US side. China will step in next. Japan is the odd guy out. But once you have even three of these, you have set the stage for a strong bull market continuing in India. We may not have to go and look at what the US index is doing, but we just want to watch where the Indian market is setting up for the months ahead, and which means new highs. It won't be surprising. 26,000, 28,000, why not 30, why not 35? You can come up with any number and it might sound believable because the sheer change, that is happening in terms of the entire environment, which will change the business environment, the spending environment that is possible, the interest rate environment, and the currency environment. All of these things changing favorably can, spill over into a multi-year trend, because these things don't just stop. If the dollar is starting its bear market next stage, then it's going to go down significantly from where we are. And that triggers not just an emerging market rally, but an Indian stock market rally as well. So that's it. I think in a nutshell, what I've said is that this is very exciting to watch the dollar and bond yields break all their previous lows and signal that yes, we are in a bear market for the dollar and for bond yields. And both of those are very positive triggers for emerging markets that should continue to provide fuel for these markets. And we should continue to see new highs, in the Indian indices in the months ahead. So that's the stage. And let me leave you with these thoughts, repeated multiple times as I must, to make the point very, very clear that it's not over. There's a lot of opportunity to make money left ahead in the months and years to come. And we should not focus on the short-term deterrents, which might be temporary. Thank you.